Good evening. Thank you for attending today's session. कहते हैं ना without attendees sessions are never perfect. So I am thankful to everyone for attending to this section and making our session perfect. First of all, also I would like to thank CA Samesh Subhash Saraf ji, who has accepted our request and to spread his vast knowledge of internal audit with all the members through today's topic, process-based internal audits. I have been given task of introducing him, so it's my pleasure to introduce today Mr. CA Samit. I would like to give his brief introduction. Apart from being a fellow member of fellow CA fellow chartered accountant, he is also having a advanced. He is also done advanced diploma in management accounting from CIMA London. He is having a vast experience of 12 years post CA qualification in the field of internal audit, risk advisory, statutory audits, and tax audits. He is a partner at Kirtane and Pandit LLP at Mumbai. He is leading the practice of internal audits and risk assurance for mid-sized, large, and listed corporations pan India, which include listed company, privately held entities, government corporations, NPOs, as well as MNCs. He is a managing committee member of the prestigious BCAS Bombay Chartered Accountant Society from 2022 to 2025. He is a convener of internal audit committee of BCAS from 22-23, 23-24, and 24-25, 3 consecutive years. He was also a member of internal audit committee of WRC of ICI for 22-23. He is a core group member of the BCAS since the past 10 years. He is also a contributor. Apart from doing all this, he is also contributing to BCAS Referencer, annual publications of Bombay Chartered Accountant Society on the subject of auditing for past 6 years. He is also a speaker at prestigious forums such as IASB, ICAI, BCAS, WIRC, NIRC, SIRC, CIA, etc. on the subjects of internal audit as a technical contributor, ICI publication, and a trainer faculty at ICI various certificate courses of internal audit. He is a board member of Global Chamber of Saraswat Entrepreneurs, popularly known as Saraswat Chambers. With this brief introduction and vast experience, I welcome on the for this forum CA Samit Saraf ji. Please, floor is yours, sir.
Thank you, Kirti ji. Is my screen visible?
Yes. Yes.
Okay, thank you. So, very good evening to all the participants who joined in today. Firstly, I would like to thank the Board of Internal Audit and Management Accounting (ICAI) for giving me the opportunity to address you all in today's webinar. Also, welcome all participants. It's a privilege today, as today we are taking up a critical topic that forms the backbone of organizational excellence, which is process-based internal audits. It applies to all the corporates, be it small or be it big. In today's rapidly evolving business environment, organizations are facing an ever-growing need to balance the compliance, the efficiency, and also concentrate on continuous improvement. Gone are the days when internal audit used to just be about vouching or ticking the boxes and following checklists. Now we have to recognize that audits, when we are approaching them with a process-based methodology, they are going to serve as a powerful tool to align the operations, that is the operational activities, with strategic objectives of the company, of the corporate, which will help to also improve the risk management initiatives and foster this culture of innovation and accountability throughout. So with this small preface, I would like to delve into today's presentation. We'll have a quick look at the index. First, we'll be looking at the definition of what is internal audit. This is important for those who are new to the subject and are attending today. Next, what is the expectation from the internal audit function by various levels? By various levels, I mean audit committee, then the executive management, and thirdly, the process owners. Next, we'll look at what is the internal audit process flow. So whenever you take up any internal audit, let's take an example of P2P, procure to pay. How are you supposed to approach it? be it planning, fieldwork, reporting, follow up. We'll be looking at each of those stages in depth today. We'll be then looking at these four pillars, like I mentioned, and one of the core parts of today's presentation is about two processes that we are going to look at, which is one is P2P, procure to pay. Second is O2C, which is order to cash. We'll be looking at various aspects to remember as you plan the audit, as you're doing the fieldwork. What are the areas one should remember while taking up either of these processes for internal audit? And some of my experience also I'll be sharing as part of cases and examples. As we move towards the end of presentation, we'll be looking at what could be challenges, because these are the positives as to how you do audit, but there can be some obstacles, there can be challenges which we must anticipate and we must know, so that we can overcome them. We'll have a look at some bullet points again from my experience. And lastly, how can we as internal auditors add value with each progressing audit to our clients? So again, from my experience, I would like to share some of my views, and that's how we'll be doing today's presentation. The definition of internal audit as per the Institute of Internal Auditors, that's IIA, is internal audit is an independent, objective assurance and consulting activity designed to add value and improve an organization's operations. It helps organizations accomplish their objectives by bringing a systematic, disciplined approach to evaluate and improve the effectiveness of risk management, control, and governance processes. The items that the words are marked in bold are very important. That independence we need to maintain, the objectivity we need to maintain, add value with each progressing audit, again very important aspect, and GRC, that's governance, control and risk management, is a given for all of us working in the internal audit domain. These items, these words are the guiding force, and this is how every audit we must do. So it's very important to first understand what internal audit is all about. Next, with regard to what are the expectations from internal audit function, the audit committee, some of you on today's call would have presented to the board, would have presented to audit committee, so you may know. For all the others, the insight is in the audit committee or the board meetings, crisp reporting and assurance on effectiveness of controls, adequacy of these controls, be it IFC, be it ICFR, be it RCMs, that is required from the internal auditor. All observations may not make it in the final executive summary that we are presenting to audit committee. Hence, it's important that only critical high risk observations where board's attention is warranted, those are made part of the audit committee presentation. Reporting all high risk observations, like I mentioned, that's the time that we are given in board meetings or audit committees. So we have to make the most of it. And with most boards, in my experience, compliance to the statutory regulations, be it finance acts, be it labor acts, many a times it can move to business acts as well. Example is Factories Act, Industrial Disputes, Apprentice Act. There are many such acts that apply to companies, and they may vary basis the sector of the companies. So this adequacy, whether these controls and compliances are being maintained, that reporting is expected from internal auditors. As we move to the C-suite level, which is the executive management level, CEOs, CFOs, for example, they're looking at the value addition from internal audit domain, internal audit function. Are we giving new findings with each audit? Or we had 10 observations in P2P last year, same observations are coming in P2P in the current year. That is not a value addition. Rather, that also shows that maybe root cause perspective, we could not identify and could not nip it in the bud or could not address those concerns in the previous year's audit, which is why it has come up as an observation once again in current year's P2P audit. So value addition is absolutely important because those qualitative parameters are verified. Emphasis on cost control measures. Are we pointing out any cost overruns, any revenue leakages, which can be valued in terms of financial parameters, in terms of rupees, in terms of amount? Are we bringing these observations as well, which have direct impact on the P&L balance sheet? Reporting observations would be mapped to audit fees paid many a times as we do each audit. The more we can help estimate or arrive to a value as to each observation, be it revenue leakage, be it cost overruns, That also is mapped to how much audit fees we are paid many a times. So it's extremely important not just to bring out an observation and say this is the problem, but also to quantify in the samples that we have checked. If we can quantify these gaps and the error population, that will help the readers of our report. Lastly, coming to process owners who are part of each of the departments which we audit. It can be purchases, it can be sales, finance, HR, as the departments we take up. Here, the expectation is that we as internal auditors would like us to understand the working constraints on the ground level. An example of this is many a times the SOP mentions XYZ processes to be followed. But on ground reality, many a times it may not be possible as well. There may be some hindrances as to why these processes cannot be followed. So they would want us to understand these issues, and we as auditors, if we can bring and bridge the gap between the management and these issues on ground level, that also is a byproduct and can help us bring more efficiency as part of the audit. To avoid reporting issues that are addressed during the audit. Now, this is a judgment that each internal auditor has to make. If the observation has the importance, if we can, it has a risk that is material enough, then we as internal auditors have to take the judgment whether to report the same or not. But dropping observations without adequate evidence is not advised at all. The trail of the entire observation start to end may be maintained as part of documentation, but each observation needs to be tagged with a reportable or a non-reportable, and that judgment remains with the internal auditor. Coming to the internal audit process, again, we'll take an example of a procure to pay audit. How do you plan? What is part of fieldwork? How do you report and what is follow up? These are the four major pillars. Quickly, we'll just take the example. When you plan, when you start planning as internal auditors, this particular audit of P2P, first, we may send the audit notification letter. In today's time, it can be an email as well. This email goes out from the internal auditor's side to the audited department, the HOD and the process owners. At the back end, as internal auditors, we start to gather background information. Now, this can be information that is available in public domain. This can be past internal audit reports or any study material that may help us plan the audit better, uh, and something to do with the area that has been taken up for audit. Identification of risks. If the RCM, that's a risk control matrix, is available or made available to us, as part of planning, it's important that we review the same so that we know which are the critical risks, which are the high, medium, low risks, so that we can plan our fieldwork in a much better way, and the checklist also can be aligned accordingly. Next is to create the audit program. Now, basis our review, basis our background information or whatever we have covered as part of planning, the audit program is prepared, and the team, as internal audit team, we are ensuring that all of the members of the internal audit team are aligned to what we have planned as part of internal audit. Once we are prepared, an entrance meeting is called with the client. At this entrance meeting, the opening meeting, many of us call, we are discussing our audit objectives at this point in time. What is the scope? We are also showing the list of requirements, the list of data requirements that we may have to the audited department, which consists of the HOD and the process owners as part of the department. At this point, we may want to solicit input if they have any suggestions as to any areas in the scope that we may have missed, any amendment to the scope that they are suggesting. We can solicit that input, note it down, and if we feel fit, note that down and include that as part of the scope of audit and list of requirements. From our side as internal auditors, it's very important for us to introduce the team, introduce the person in charge, and also the time that we are going to take as part of field work, so that there is least amount of obstacles to our team when they are on site. Post the entrance meeting, the LOR is sent out to the client, and data starts flowing in to the internal audit team. Next, we reach to the field work, which is the second stage. To start off the fieldwork stage, it's very important that we take up interviews or walkthroughs with each of the process owners and the HOD to understand the day-to-day responsibilities and the scope of their work that they are covering. As part of fieldwork, we also have a sampling that we may take up. Many a times the data will be very bulky, so it may not be possible for us to audit the entire data. Flip side is if it is in ERP environment in today's times, we can extract the data dump from the ERP and analyze the same by using audit tools and Excel as well. But in cases where data is more bulky and more in hard form or hard copy form, we may have to use sampling as a method. This data, once we are communicating and it's received by us as internal auditors, we start reviewing this documentation and side by side the processes, which is SOP, the process manuals, any IFC framework or RCM matrix, all of that as well, and start testing the same as part of fieldwork. Observations may flow as part of this, and now we reach the stage of exit meeting. That the fieldwork is ended, and the exit meeting that we call is one where we discuss the audit observations, the draft audit observations, along with the annexures that serve as evidence and proof as to why we are pointing out certain observations to the team. This presentation is typically made to the HOD again, to the audit department. At this point in time, observation wise, you resolve the questions, the concerns that the audit department may have, and explain the observation from our perspective. And the logical flow is us seeking management comments to each of these observations and setting up a target date for remediation or correction of each of these observations. The third stage is the reporting stage, where the culmination of the draft observation sheet is made as part of the draft report. This draft report is again shared with the management for vetting as to management comments, target date, if that is properly documented by us. And finally, the final report, the signed report, is then shared to the stakeholders. It's mostly the senior management of the board. The most important stage for any audit is the follow-up stage. ATR, action taken report, is covered as part of this stage, where the target date that was promised to us as part of this audit, before we take up the next quarter's audit or the next run, it's important that we check whether target dates have been met. And how do we check target dates have been met? Certain retesting of the corrective actions taken of the new data is important, so that we know that the actual observation or the fault or the audit observation that we found was corrected in the system, and that will help curb repeat observations on same lines in the future. If we see that the remediation is not done properly or corrective action has some gaps, we may want to re-audit that as part. But this communication to the auditing department that it has not been closed properly is absolutely important. So as part of internal audit, communication with all the stakeholders, top and down, is very important, and we are in a very good state to enable this communication in a timely manner. Going further into what are some important aspects of each of these stages. First, we'll look at planning stage. You're defining the audit objectives, that is looking at the purpose and the scope. Uh, we've tagged it as SMART. Now, what is SMART? S stands for specific, measurable is M, A is achievable, R is relevant, and T is time bound. Objectives of the internal audit are not beyond SMART. So very important, be it any area that we take up, P2P, O2C, HR, finance, etc. This remains common. Understanding the observation, like I mentioned previously, there is ample information, especially in the listed company's perspective, that is available in public domain about the sector as well. So that is business information, sectoral updates, background research material about the sector. There are so many study reports, industry reports that are published by various institutes. We have access to it, and some on a paid basis, some are free on public domain, but those should be researched so that we as auditors know what is happening or what are the dynamic movements in a particular sector or a company respectively. Are there any cases of material impact due to external factors? Now, great example of that is pandemic. It did impact certain sectors like travel tourism, for example. So it was very important that what is that particular impact, how it impacts the business, how it impacts whether the client is in export sector, and many exports were stopped at that point in time. So these external factors are again a culmination. So it's very important that we understand the sector, the business, and where the organization is going, so that we can incorporate that as part of our internal audit objectives. Identification of the audit universe. Now, audit universe typically is made up of two parts. One is a core and one is a support function. If you take up an example of manufacturing company, core functions are production, order to cash, procure to pay, inventory, whereas support is finance, ITGC, or HR, for example. So audit universe is typically all the processes that are up for audit. In a particular year, you may take up 4 to 6 such processes, and across a span of 3 years, you may cover the entire audit universe. Again, this differs from entity to entity, and this is purely suggestive. Risk assessment again is a very important part of planning stage. So timely identification of risks that are applicable to the business. The way we can review this is asking for the RCMs or the ICFR or IFC that is prepared already. If not prepared and the threshold has not been met, this again creates an opportunity for internal auditors to provide value in terms of designing as well, if that's possible, or if it's already designed, we as internal auditors can test the same. But designing and testing is mutually exclusive. The same internal audit team should not do both. So testing typically, as part of experience, what I have seen, does come up in many audit plans across the year for many companies. So whichever processes are audited, the ICFR or the RCMs have to be tested as internal auditors, being an independent activity for us as part of the annual audit plan. So that covers risk assessment. Before we begin any audit, engagement letters as part of very critical documentation for internal auditors is signed. Now, what are the contents? Typically, what is the audit? What is the scope of audit? What are the responsibilities of both parties? What are the timelines? What is the professional fees, emoluments that have been discussed? And the annexure would be the audits that are planned throughout the year. What is the frequency of the same? So this crystallizes the terms of engagement that internal audit firm has entered into with the client entity. At our end as internal auditors, very important stage of planning and leading to the proposal stage is us understanding the resources that are required on that particular audit. What is the skill set of these resources that is required? What is the time frame that is allotted to us as part of the fieldwork, uh, which will help us formulate the audit plan. This stage of resource allocation, skill set, etc., and the time frame will help us prepare the proposal in a much more accurate way, and accordingly, the commercial proposal will be shared. So, if things go wrong at this particular stage in planning, it may have an impact as to when we end the audit, which may result in a cost overrun for the internal audit function. So, very critical is to aim to estimate this much better. Audit plan discussion with the management. Once the audit plan for the year is prepared, it's very important that it is discussed with the C-suite level and then the board solicit any feedback that the management may have so as to tweak, if necessary, the audit plan, and then it is signed off by the board or the audit committee as part of in the next upcoming board meeting or the audit committee meeting, and it is minuted. If there are any changes that are made during the year for XYZ reasons, it's very important that again that trail is mentioned and the trail is maintained, and then any changes are made to the annual audit plan. If that is not the case, every quarterly meeting of the board where internal auditors are made to present the quarter's observations, it's important that we give an update as to where the annual audit plan has reached. This again gives a perspective to the stakeholders as to the progress made by internal auditors. Coming to stage number 2, which is fieldwork. At this stage, like I again mentioned, it was walkthroughs. Your data collation interview stage is very important. Data collation happens in 2 ways. One is where we have access to the ERP, where we can extract the data ourselves from the ERP, where in option number 2, where access to ERP is many times not given to internal auditors for again many reasons, maybe confidentiality. At that point in time, the list of requirements that is shared by us as internal auditors with the client, the data is extracted from the client side and emailed to us or provided to us in line with the LOR. So this is the first stage that we cover in fieldwork. Next is again performing analytical procedures. If you are using any data analytical tool, churning this data as part of the data analytical tool and getting the exception reporting again helps a lot in terms of output. If you do not use such tools, you may use advanced Excel and manual methods to churn the data and analyze the data as to get the observations and exception reporting. Important here is to also validate internal controls. When you look at RCM or when you look at the ICFR, the documented controls is mentioned in the same matrix. So it's very important to side by side look at such matrices as to when you are auditing, so that if you see any gap in terms of what the SOP mentions, what the RCM mentions, what the ICFR mentions, versus what you are seeing on ground while conducting fieldwork, that will help you provide a gap analysis report during the fieldwork stage itself, so that draft observation sheet at the stage of exit meeting would have these observations, and you can discuss in a more fruitful way with the auditing department. When it comes to sampling, again, data analytical tools enable us to have a sampling which is far more advanced. If that is not the case, you may use stratified sampling or random sampling, as the case may be, especially where data is bulky and enables you to look at hard copy data or physical data, which may consume more time and resources. When it comes to benchmarking, many a times whenever we do process-based internal audits, the expectation is, if we are also looking at other clients or other client entities in the same sector, uh, what is the sector doing, where are the companies progressing, if that insight we can provide to the clients in sort of benchmarking methods, so that they can also make that journey to improve their processes to make it more efficient, that will also help. When it comes to the documentation and evidence stage, very important is how this observation control sheet is being prepared. We call it the OCS. Adequacy, the observation tracker. What is the control evidence basis which the observation you have brought out? The evidencing is very important. That can be tagged as annexures, and this will help form basis for the report. The intent of the observation control sheet is to help us prepare the report in a much more smooth manner, so that you spend lesser time and use your time for more better aspects of the audit. So the natural flow of the observation control sheet is to make your final internal audit report. Having open communication with all levels, start to end, that will entail from planning right up to follow up. Important aspect here which I would like to throw some light on is having flash reporting. An example of this is, if you are auditing statutory compliances as part of the annual audit plan, and sometimes what you may look at is a particular observation that comes which is absolutely critical. You cannot wait up to the exit meeting stage also, because you identified it and it has a very high risk and an impact to the client. You may send out the observation again with the evidencing as part of a flash report to the internal audit head or to the management member who is dealing with us as internal auditors from the client side, so that they can take the action on an priority basis and not wait for us to meet them as part of exit meeting. So that is flash reporting. And again, this boils down to the judgment of each internal auditor whenever you're doing the audit. The wrap up and the exit meeting typically is a culmination, a summary of the observations that we've seen. And we record the comments and the target dates, like you mentioned. Reporting will again have the audit report that we prepare, which again flows from the observation control sheet. Um, you may, as internal auditors, already have a standardized internal audit report format. As we progress in the presentation, I will also share how our internal audit report format looks. But again, you are free to tweak. But I would like to mention the important columns or the data fields that an internal audit report should have. And we'll speak on that as we progress. When it comes to having communication, again, objectivity is very important. Being unbiased is important. And whenever we speak as internal auditors, it should be fact based, which should be backed by data at all points in time and not making any callous statement. Highlighting findings, any deficiencies that we've seen, any control weaknesses compared to the ICFR or the RCM matrix that is documented, any non-compliances. Now, these non-compliances can be statutory, or there can be non-compliance with regard to process. In the latter, it's typically SOP mentions a certain process to be done in a certain way, but when you're doing the field work, you may see that there are certain deviations which are going unnoticed. So that again becomes as part of a non-compliance. Here, these are the opportunities for improvement, and that is what drives value add. So, as internal auditors, we are the eyes and ears of the board, and we must bring these facts to the table so that improvements can be brought in, remediations can be brought in. See, whenever you're drafting the observations or the internal audit report, or even having email exchanges with the auditee or the client, it's important that we use clear, concise language and avoiding any technical jargons or terms which we may understand as internal auditors or chartered accountants. But many a times we have to sensitize and tone it down so that the client understands the intent with which we are making certain statements or seeking certain data. So that clarity and brevity and keeping it simple is very important. Executive summary is a subset or a curtailed version of the detailed internal audit report, and it's a high level overview of the entire internal audit report, which will cover the high risk or the critical risk observations, issues, which will be communicated to the board or audit committee. And lastly, the findings and recommendations. Every observation that you bring out as part of internal audit report must be backed with evidence. If possible, that must be given as a link as part of the internal audit report slide itself, or attached as an annexure, as the case may be. Um, and when you or us, when we give out recommendations as internal auditors, they should not be theoretical. Again, this comes as part of experience, because when you give out theoretic recommendations to the client, many a times they may not be practical for them to implement. So it's very important that you discuss and tailor make, customize the recommendations for improvement as part of internal audit reports, so that the client is able to take certain actions as well. Many a times, these recommendations may have to be broken down into phase one, which has to be done immediately, phase two, which is to be done after phase one, so that conclusively, uh, the fault that we have identified can be corrected from the root perspective. With that, I come to that root cause analysis aspect. As we look at it, there are three major root causes that we break down our report into. One is people related issues, second is business process related issues, and thirdly, it's IT related issues. People related issues is an example is weak maker checker controls, which is a manual error why the fault was observed or why an observation has come out. Business process root cause is basically the SOP mentions 10 processes to be done, but on field, when we are doing the audit, we see that certain parts are not being adhered to, or there are deficiencies as part of not following the SOP. So that will be categorized into the business process root cause. The recommendation here will be to either amend the SOP to be in line with the practice on ground, or vice versa, to ensure that the process owners are strictly following the SOP. Now, again, this will be as part of discussion between internal audit and the process owners and HOD, but root cause identification is absolutely important. With regard to IT being a root cause, sometimes the functionality in ERP may not be available. So that again becomes a root cause as to why it will be a continued issue. And this again we should be bringing out as part of each of the observations and categorize them in either of these three pillars or silos. Risk assessment and impact analysis. What is the implication of risk? What risks does the organization entail if the recommendations are not followed? And what is the impact is absolutely important for us to bring out in the audit report. Examples of risks would be: one is a financial risk, which has a direct impact on your financials, your P&L balance sheet. Second is an operational risk, where there is a deficiency in the day-to-day operations, which we are seeing. Again, weak maker checker controls is an example. Third is a reputation risk. If the organization that you're auditing is a client facing, or example, it's into retail or hotel business, restaurant business, where you're facing the consumer directly, last mile that is. So anything going wrong, which is client facing, can hurt or impact the brand or goodwill of the company. So that's a reputational risk. A compliance risk is where there is a deficiency found in statutory compliances. The organization is falling short in terms of adhering to its compliance calendar. So, if we are seeing any gaps there, it is categorized as part of compliance risk. So, these are examples of three or four risks that typically come out as part of any observation during internal audit. Distribution and review. Timely distribution to all the stakeholders, including executive management, board, audit committee for the consideration. So this is speaking about the final report being officially shared by the internal auditors with each of these stakeholders. Continuous improvement is where you seek feedback from stakeholders on the usefulness, the effectiveness of the audit. Is there anything that we can improve? Is there anything that we can bring as part of our next internal audit run that we are going to cover? So this dialogue or this feedback seeking is very important, and having this communication also is, progressive in it's a progressive approach where we can be in touch with our client far more regularly than meeting them once a quarter, once a half year, or once in a year. So that is the opportunity. As internal auditors, we must bag the opportunity and keep our ears to the ground to know what our clients are wanting. So this continuous improvement again becomes very important. And the last stage is the fourth pillar, which is the follow up stage, where as part of the action taken report, we monitor the status of these corrective actions in the report. We review the evidencing that is provided by the auditees so that to ensure whether it is closed properly. Tracking the progress, again, checking the evidence that's provided. If we need to conduct or reconduct the walkthroughs, again, that comes up here. Validation of the improvements, whether they have in the intent of why the observation was brought out and discussed and why the recommendation was given, whether the correction is done in the same intent, to ensure that as a team, that's the internal audit team and the management, we take enough action to ensure that there is no repeat occurrence of those same grounds. And communication again, ATR on a quarterly basis can be shared with the management, and an update as to whether target dates are met, or if target dates are not met, what is the next target date and why it has been exceeded. Again, that can be documented and maintained as part of ATR and provided. Reassessment of the observations that were open and taken care of. Again, this helps us ensure whether these improvements have become part of the ongoing operations. Escalation may be necessary at times when target date, for example, was given to us as 31st December. Today we are on 8 January, and 8 days have it's overdue now, and there should be a reason, that is a credible reason as to why it was not taken care of or corrected by 31st December. So that should be documented, and if there is no response or this is a continued delay, it may be again on the judgment of the internal auditor to escalate to the next level in the management to ensure that there is adequate attention given to each of these observations and it is closed in the intent that it was brought out. Lastly, it comes to closure, where us as the internal auditors, if we are satisfied that the corrective action has been successfully implemented and all the identified issues have been resolved, retesting is also complete, that follow-up process for those observations can be marked as closed, and this again is documented with evidence and reported to stakeholders. There may be cases where you may find deficiencies, so do take it up in that way, and keep the track and your hold as internal auditors on the ATR. This is common for all processes that you take up as part of internal audit, be it core or be it support. And ATR becomes a consolidated document at each point in time where real-time status of where the corrective action has reached is documented by us. Now we look at two processes. First, we'll be looking at P2P. What is the cycle of P2P? What are various important aspects to remember as you take up, aspects or your part of your checklist? What is important for us to remember as internal auditors is very important. And then we'll similarly move to O2C and progress. Procure to pay. We'll take an example of a manufacturing company. In this process, requirement planning, which is your purchase requisition, that's the first stage. What is the user's requirement? The production department may have a requirement here that is communicated to purchases, and requirement planning can be done at the start of the year. And then PRs are raised, be it in the system. If there is no ERP, then manual PRs are raised, but that's always the first stage of procure to pay. Moving to request for quotations. Again, there should be ideally a list of approved vendors that every company should maintain. Approved vendors are those where they have been onboarded through a particular process by the purchase department. Their KYC is taken on record. Their performance is evaluated. The supplier evaluation is done, be it once a year, once in 2 years, once in 3 years, given the criticality of the services or the products they provide to the company. So that ensures that they are part of the approved vendors list. Usually quotations are sought from approved vendors, and option number two is where RFPs or tenders may be floated to the open market for procuring certain items. Again, This is important for us to understand as part of the planning stage as to what is the framework that the company is operating in, how are they procuring the material. So at stage number two, once the preferred vendor or the supplier is identified, a creation of a purchase order, that is the PO, is then done. Again, mostly through the system. It's issued and sent to the supplier or the vendor. Once the goods are received at the client's gate or the premises, factory premises, a GRN is issued. Preparation of the GRN is done in the system. QC is followed as once the goods are received. Once the QC is complete, it will then move to the payment invoice stage where vendor invoice is accounted for. It's paid as part of the payment terms given in the PO, and finally reporting in the financials. This is broadly how the P2P cycle works in any organization. Now, coming to certain checkpoints that we as internal auditors must know or must take care while we are planning and carrying out a process audit for the procurement function. Every audit starts with the SOP. That's the policy. It may be called an SOP, it may be called a policy, it may be called a flowchart, process manual, as the case may be. But starting with review of the policy is absolutely important. It needs to be documented. Uh, it cannot be a verbal policy, it cannot be an unsigned policy. Practically, many times a Word document will be given as part of this is our policy. But it is us to bring out as internal auditors, very important for us to ensure and communicate that the policy should have a version control, it should have an issue date, it should have a revision date, and a version control number, and it should be signed by the HOD or any higher level, as the case may be. So that for us becomes very important as to how we begin the audit and how we are going to progress with a much more better setup. So having that defined document policy is point number one. Training on the policy. Now, why this is important is sometimes there are policies that are maintained by the procurement department or centrally in any company, um, but process owners are not given the policy or they have never reviewed the policy. A legacy practice is being followed, uh, uh, point by point, day to day. Us as internal auditors, when we come in, we look at it from an objective point of view or an unbiased point of view. The first phase of us having reviewed the SOP versus on-ground practice, we can see where the gaps are, and these gaps will become observations. So, how to correct this is basically recommend having trainings on these policies to the process owners, so they are uh, we ensure that they know what the policy entails, what are their jobs, what are their roles, and they can do it in a much better way so that it can be a much better efficient framework internally for the company. Like I mentioned, there should be version controls for revision and review. There is a need rather to update the policy on a periodic basis. Again, once a year, once in 2 years is okay. To keep it relevant in line with where the company is moving. Today, the company may be small. It grows, leaps and bounds in a couple of years. There may be that requirement of amending the SOP so as to keep it in tandem with how the company is growing and where the market is going. So that review mechanism should also be documented. Coming to supplier selection and management, how your vendors or suppliers are selected. Is there a clear criteria? Are there parameters that are determined and documented? So there can be purchase committees where addition or onboarding of vendors can be taken up and documented and then approved and included in the approved vendors list. Certain criteria are a cost, the rate that they are giving us, the quality, so references from open market can be also taken, reliability, ethics, whether they are compliant in terms of the regulatory framework. So that also tells us if they take their compliance seriously, they will be serious when they deal with the client entity. So these parameters, uh, the documentation is absolutely important. The vetting process, the vetting process starts at the onboarding stage, and which will entail background verification of the vendor, whether they are financially stable. So at this stage, we may get credit reports, credit rating reports, the financials of the company, especially when the vendor is a registered private limited company or a public limited company, easily available from ROC. So that will also help us see whether the vendor is financially stable to be able to cater to the client's needs from time to time. Are there any litigations at the vendor's end which may impact their business or continuity of business? This becomes part of the vetting process. It is suggested that there should be a supplier or a vendor evaluation process or a framework in place where you evaluate the vendor and the performance once a year, or you break it down into once in 2 years or once in 3 years. Categorization of vendors into ABC can be done, and accordingly, the evaluation can be done. So it is dual, one at onboarding stage and then the annual frequency of having evaluated the vendors. Performance reviews, performance audits of the vendor supplier, where members of the quality control team of the client can visit the particular vendor's premises to see whether all aspects are in order and they are in a position to continue catering to the clients. So this becomes part of the supplier selection and management. This is again done as a process. How we can check as internal auditors is firstly to see whether such processes exist, and if they exist, are they being followed as they are documented, and if we see any gaps, we should be bringing out recommendations and suggestions for improvement to ensure that the intent of the management is met. Standardized purchasing process. Important point, like I mentioned, is approved vendors, where purchases are only made from approved vendors. The only exception being the RFQs that are given to the open market. Is there a possibility to automate the purchasing process where possible? Again, this is to avoid any manual interventions or manual errors, so that we can increase the efficiency uh, and automate as far as possible. Today's dynamic times, ERPs are being used by most of the clients. So automation is possible. So when we as auditors look at each process, each sub process, we will see whether the functionality can be integrated, whether certain controls can be integrated into the ERP. These suggestions are expected from internal auditors to ensure the ERPs or the softwares that are used to the maximum extent possible, so as to extract that value for the client. Process audits, regular audits of the purchasing process to ensure compliances. Now, again, like we are auditing as internal auditors the client, it's very important for the client also to conduct these vendor audits from time to time to ensure certain important criteria are maintained or not. Industry benchmarking, looking at certain vendors, whether the similar practices are being followed by the peers from a continuous improvement perspective, whether we can bring in that standardization or the insight from open market peers to the client, so that purchasing process that is developed at the client's end is taken care and made more robust. Coming to specifics, which PO stage is very important. It suggested that mandatory usage of PO is done for all purchases, and if there are any non-PO cases, again they are documented as part of the SOP. Small purchases, be it stationary purchases, office supplies, many a times are non-PO, but critical items like raw material, etc., are always to be driven through a PO, and the PO framework has to be maintained. As auditors sometimes, and from again experience, it has been seen that the PRs are made after the POs. Now again, that is a lapse. The PR has to always precede the purchase order. The process is PR, PO, the GRN, QC is done, invoice and payment. If you see any of these processes not following this particular cycle, uh, it may indicate that some backdated entries are being passed, or there is some other deficiency that can be identified and brought out by internal auditors. So these are specifics that we as internal auditors need to remember whenever we conduct this process audit. Detailed specifications in the PO. Again, PO should contain the item description, cost, delivery date, terms, payment terms has to be documented. PO number has to be serially numbered and automated given by the system, so as to ensure PO register is updated at all times. If when we download the PO register from the ERP, you see certain serial numbers missing, that may indicate that POs have been deleted. So these aspects we can bring out as part of our internal audit and give these insights, because day to day it may always not be possible for the client to identify themselves, which is why internal audit is important. Approvals, whether these POs are approved as part of the authority matrix. Now, very important point you have to remember is splitting of POs. I'll give you an example. Value up to 50,000 of a PO is approved by the HOD of the department. 50,000 to 5 lakhs is approved by the CFO, 5 lakhs and upward of a PO is approved by the board. Now, if we do not want to go to the stage of CFO, if the PO of 4 lakhs is split into 10 POs of 40,000 each, is such things happening? And if such things are happening, through data analysis we can check whether PO split has been indeed done, and then you reach to the root cause of the same and find out as to why it has happened and flag such observations when you find out deviation from authority matrix with a bad intent. We as internal auditors must point out. Hence, it's important for us to check the documented authorization matrix as part of SOP, or in an ERP environment where integration is also possible. Whether those levels have been authorized or not is something we can check as part of audit. Coming to GRN, whether GRN is entered for all incoming materials, again, records can be maintained in the ERP. And accordingly only, there are many byproducts of the same. A, payments to transport agencies, again, flow of the same, firstly into stores and then being issued to production. GRN again is a very important stage. So at source, is GRN being entered or not? Gate inward is it being updated or not? Stores data updated or not is something we can check side by side while conducting the audit. Check if there is any delay in terms of creation of GRN, and reasons thereof can be then discussed and taken ahead. SOD, which is segregation of duties, is it being followed? Example is whether the same person entering the GRN is the same person amending the GRN and then issuing to production, or are they distinct people who are handling these distinct activities so that there is no conflict of interest. Again, this insight is something can be checked by internal auditors. Quantity of GRN differs from that of PO. PO says 100 quantity, GRN has 150 quantity, and we have accepted it. A will entail into an excess payment, firstly to the vendor. Secondly, it will take up additional space. So, does the company have a tolerance limit if it is going to accept excess material? Are these tolerance thresholds mapped into the ERP, or are they being checked? Is something a checkpoint that we should bring out. Three-way match, a PR, PO, GR, and invoice. These various three-way matches can be brought out. Ideally, in an ERP environment, linkage is possible. In a invoice register, the PR, the PO can be traced as well. The GRN can be traced as well. If you have an invoice register which does not have a PO number, we may want to check the root cause as to why the said PO number or the PR number is not featuring in the invoice register and reach to the root cause of it. Coming to invoices, it's very important as a checkpoint. Vendor masters compared to the employee masters, again, there may be certain data fields, be it address, mobile number, email ID, name, similarity in name, which can feature in both these reports. So this can indicate possible fraud if that is the case, where an employee is also disguising as a vendor and taking preferential treatment from the client. So that is an indicator for internal auditors that we can bring out. Verifying the vendor invoice information with online database, public records, and KYC repository. Now, there are two ways to tackle this particular process. There are certain tools available in the market where it's more automated. There is OCR technology where the invoices are scanned and there is a two-way match that is done. One with the government repositories where your MSME number is mapped and checked. Your GST number from the invoice is mapped and verified online. Again, PAN is done. So all these regulatory information that features on the invoice is automatically checked with the databases or the portals. And the other side of it is the PO terms, the payment terms, the material code can be verified with the internal data that is maintained on the ERP. So there are tools that are available. If that is not the case then the flip side is to have it checked manually, where us as internal auditors need to run these particular vendor information that is on the invoice manually, either on the database, the government portals, or internally on the ERP. Check if vendor master's information, which is, for example, a bank account number, is featuring on the vendor invoices as well. So the bank account number in the masters versus what is on the invoices, if it has changed, but the changed bank account number which is showing on the invoice was not communicated, it can indicate that payments are being made to other accounts which are not known to us. So again, if you see as auditors these gaps, we may bring out. There can be genuine cases as well where genuinely the bank account has changed, but for us as auditors, It's important to be curious. It's important to have that third eye, so as to allay any fears of such wrongdoing if it is being done. Whether invoices are approved as per the authority matrix. So authority matrix will apply across for PO, for invoice, because it's a central activity per process. Any deviations that are noted have to be flagged. Again, one more example I'd like to give you. Suppose the HOD is not in office on a particular day; it is marked as leave on the in the attendance master. But certain POs or invoices are being approved on that same day of the HOD's leave through the HOD's account, again may indicate that there is someone else who is using the particular login just to approve these POs or the invoices. If we compare the attendance masters with the date of approval or authorization of the POs or invoices, many things can come out. So this is how we can do our job in a much more deep dive way, where the canvas is wide and we, as deep as we want to go as internal auditors, we must. Payment processes. The payment should always be made on the basis of approved invoices and matching PO. Typically, in practical scenarios, from the purchasing department, the approved invoices will flow to the finance. Finance will vet it as last mile, and then the payments will be made. Again, taking care of the TDS deductions if the case is that, on any other regulations or compliances. Finally, payment is made from finance. So it's a cross-functional aspect, and it should flow from purchase to finance. Payment should be made only after the three-way match. If this is not done, again, this can be a suggestion when you're process audit, that a PO, a GRN, and vendor invoice should be mapped and matched. And if there's any discrepancy, that should be brought out, and payment should be made only after this match is complete. Payment authorization, again, to avoid any issues in segregation of duties or conflict of interest. The authorization should be done by a person who is different from the person who has authorized the PO. Same person authorizing PO, same person authorizing invoice, not ideal, which is why it's important that it flows from purchasing department to finance department. So automatically there are two different persons and authorities who are taking care of these aspects. Maker checker is maintained. AP reconciliation, AP stands for accounts payable. Periodic reconciliation of accounts payable. Again, if the automation methods are also available, there are certain softwares where balance confirmations can be taken from vendors, from banks, from customers as well. So more usage of these tools or softwares that are available will help make the company's efficiency better, as well as internal auditors can also do their job better and concentrate on much more important aspects rather than keeping it transactional. Lastly, looking at taxes and compliances. Again, from my experience, I would just want to mention certain compliances that should be looked at while doing a P2P audit. A, when you're dealing with expenses, for example, contractors or professionals, the requisite TDS is to be deducted as per the prevailing laws. It's dynamic, new sections keep coming in, so that reading from internal auditors' perspective in the planning stage is very important. Any new sections that have been introduced in the quarter or the current financial year, are they being taken care properly? Is our reading appropriate? Do we know the actual aspects of what the section says? It's very important. Half knowledge will entail that observation to be left with many gaps. So knowing the TDS requirements is very important. 206 AB compliance, many of you will know, it is where the specified persons are pointed out. If you are non-filers for 2 years or more in terms of IT return filing, then the TDS rate will be more than what is advised currently by the TDS chart. So 206 AB compliance can be validated on the income tax portal. Many companies do it. Many companies do it more regularly. Some companies do it once a year. Some companies may not be doing it at all. If in your case, client company is not doing it, please try to involve this particular activity, especially when you are doing P2P, statutory compliance, or finance audit. GST, there are many aspects. GST is an ever evolving act. Many of us will know, and we are working in the same. So, whether current rates are being charged, whether HSN nomenclature is taken care of, SAC nomenclature is taken care of, block credit as per section 17.5, ITC section 16.2, whether reconciliation of 2A, 2B is manual, automated, many aspects are there. As internal auditors, when we take up statutory compliances or finance as an area, we may have the resources to look at it in a much more deep dive. But since it's a regulatory act or a statute that applies to almost all the companies that we will audit, it's important for us to know the important sections that apply. MSME Act, many of you will be aware that the MSME Act 2006 speaks of payments to be made within 45 days. And if not made within 45 days, as per the Act, three times the bank notified rate has to be provided and paid to the vendors. And reporting also has to be made to the ROC in a half yearly manner. The new section that has come is 43BH of the Income Tax Act, where if payment is not made within 45 days and the status is taken on 31st March of every year, then the entire value of the purchase or the expense, as the case may be, will be basically added to the computation, which will have a direct impact on the profit, direct impact on the tax that is paid out. So it's very important that the 45-day rule is taken care, it's complied with at all times. And since MSME specifically is an area that MSME Council looks at, your income tax is going to look at, ROC is going to look at, it's absolutely important that we provide those insights in terms of the dynamic loss when we are covering this process audit to the client, and flag if you see any deficiencies. E-way bill has been around for some time now. So whether these e-way bills are generated and annexed to the vendor invoices, that's important from our perspective when we check the invoices as part of the process audit. If it's in soft form, also it is okay. E-way bill registers can be downloaded from the portal, from the government portal, mapped to the e-way bill register in the ERP as well. And with a simple VLOOKUP, also we can find out whether there are certain gaps, whether there are any deliveries that were done where there was no e-way bill, although e-way bill was applicable. So these insights we can bring out. Practically, if you look at it, certain time frame of 72 hours is given in e-way bill. We may, as internal auditors, not doing a real-time audit, but again, when we take up the audit, there is that opportunity for us to flag these certain deficiencies that we have seen in the quarter or the period that we are auditing, that these aspects were not taken care, these were done with a delay, or in some cases not done at all. So process level improvements, as far as possible, how much we can bring in will in turn add to our value addition. Coming to contractual agreements, ideally, if not, there is no PO in place, at least a contractual agreement should be done. More so, this you will see this in service providers, where there are master service agreements that are maintained. So, what is important for us as checkpoints? A, whether standardized contract formats is being used for all suppliers by the client. Are the clauses also common? The clauses example, one is the penalty clause is there, the arbitration clause is there, the professional fees clause is there. I mean, whenever we look at this as internal auditors, our drive should be to look at it from a standardized perspective. Contract approvals, whether these contracts are approved by legal prior to sign off by the HOD, again very important, because if something were to go wrong in future, if there is litigation in this particular vendor's case, if the legal has not vetted or there are some deficiencies found in the particular agreement, it will go against the client entity. So having these contract approvals documented is in the interest of the company and should be a checkpoint for us to make this process more robust. Contract database, again, if a centralized database of all these active contracts with their expiry date is being maintained, that's great, we can review it. If it's not maintained, this tracker is missing, again, this can be a recommendation to make this process more robust, so that as the agreement is about to reach the expiry date, the renewal can be taken up much in time rather than waiting for the expiry date. Penalty clause, very important, especially where quality issues, rejections, certain non-conformities from the vendor side. Do we have, as a company, any penalty clause that we can apply on the total value of the invoice? If it's documented, it's better, so that it reduces any stress of litigation or recoveries through debit notes in future. Segregation of duties. Looking at it from an ERP environment perspective, whether these roles have been adequately documented or integrated as part of the ERP, A, in terms of procuring, approval, receiving, payment broadly, avoiding the same person doing conflicting activities is the basis for segregation of duties in any process. In this example, it is P2P. ERP controls whether these SOD checks are carried out to avoid conflict. Now, this becomes our checkpoint as internal auditors, where we can check the person approving, the person amending, or the person paying. We can, through the ERP controls, look at the user logins when the user logins are done, and various checkpoints can keep adding to ensure that we can give that assurance to the client entity with regard to SOD. Mapping the active employees database, whether the names of the newly added or the departed employees are given effect in the ERP. Again, last working day, if it was 31st December, until today, which is 8 Jan, the user login is kept active. And has anyone used or made entries on that recently left person's user login in the ERP? That can show in the ERP, but someone should review it. So having this activity done during our audit is an absolute important checkpoint for us to ensure that the active employees database is seen in the ERP as well. So that data from the HR can be weighted of what we see when we do the audit of P2P. The example like I've given, same person procuring, paying, inventory counts done by distinct personnel. So as a judgment, as internal auditors, we can apply from a case-to-case basis. Moving to the next process, which is order to cash. The cycle of order to cash is basically five pillars. One is receiving the orders. Second is doing a credit assessment of the customers. Third is order fulfillment, that is delivery. Fourth is billing receivables. And lastly, receiving those payments into the company's account and reporting the same. For the first stage, which is receiving orders, what I've done in this O2C presentation is basically, again, similar to P2P, what should be our checkpoints, what are those certain parameters that we must inculcate or incorporate into our checklist to ensure that we are checking from a holistic perspective. Every audit starts with the SOP, like I mentioned earlier. So here as well, walking through the process, the SOP, the flowchart of the particular sub process, which is receiving orders from clients, is something that the internal audit team should do. Certain important parameters that we can check as part of our process audits is if orders are received from blacklisted parties or defaulting customers, having tagged them as blacklisted parties or defaulting in the ERP, still fresh invoices are being issued. Again, that signals that there is overriding of the control that has already been set and creates a risk of bad debt. Now, if you, as a company, issue an invoice of a certain value to blacklisted party, you may not know if the money is going to come. Again, delivery will also happen. So goods are also out, and there is this confusion of whether monies will be received or not. If it turns into a bad debt, it is a direct impact of a financial risk to the client. Differential pricing offered to similar customers, again, it's a reputational risk. Take for example, it's a RMC business, RMC standing for ready mix concrete. There are various grades of ready mix concrete that are given to various builders and construction companies. Now, if there is grade A, for example, and the rate is 5,000 for a client and 5,100 for a comparative client in the same demographic area, and if this difference is large, the industry is small, again, differential pricing may impact last mile businesses. So that can be a checkpoint for us if it is not documented and done at the whims and fancies of the marketing team. It can create a reputational risk. So we can bring this out as well. Authorization matrix in terms of receiving orders. There are certain examples that I have jotted down where it can be documented. First is opening the new customer master in the ERP is one. Setting the credit limit terms and whether overriding is done to the credit rule is number two. Third is sales order created on the basis of customer PO. Canceling the sales order, modifying the sales order, whether samples are given out free or paid. Discounts, who can give discounts, what is the value of discounts that each level can give, and to which customers it can be given. Bad debts provision and write-off, who is documenting the same, quantifying the same, who is approving the same. Again, authorization matrix needs to be there. Credit note issues, again, authorization matrix for the same. So these are activities within receiving orders silo where authorization matrix needs to be followed. Best if it's done as part of ERP. If not, at least another documented alternate mode like an email is also okay if ERP functionality is not available. Another checkpoint is whether mismatch of pricing taxes in the sales orders versus the invoices raised. So, like we saw the three-way match in P2P, there are various three-way matches that are possible in O2C as well. So that is something that again should become an important checkpoint in the process audit. Credit assessment perspective starts with there being a credit policy in place as to if it's a new customer, for example, an advance payment should be taken rather than a credit limit being given. That's an example of how you set credit terms, how you offer credit terms to new customers. Similarly, customers can be categorized into ABC, new customers, existing customers, as the case may be, blacklisted, defaulting, various sub items can be made part of the credit policy, and is documented, and the company is required to adhere to the same. As auditors, we review the credit policy, we see the actual entries, transactions that are being entered during our period of audit. If we see a gap, we should bring it out, and if there is a deviation from this said credit policy, whether the third party agency is asked to carry out the assessment. Now, this speaks of credit assessment. There are agencies that carry out certain credit assessments. If that is not possible in the client's case, the internal finance team as well can do this activity and support the sales department by carrying out a credit assessment of these customers. Now, certain activities that are covered as part of assessment is analyzing the financial statements, understanding the business, any personal guarantees that are given by directors, that can also be seen. And very important is site visit to the customer's office, site visit to the customer's premises to verify whether it is a legitimate customer and not just a fly-by-night operator. So these assessments are absolutely important to ensure that the company does not face any issue in terms of bad debts or delayed recoverables or litigations. Next is the frequency of credit assessments. Is it once a year, once in 2 years, once in 3 years? Again, depends on categorization. But once it's documented, us as internal auditors can check whether credit assessments are actually being carried out with the defined frequency that has been documented. Defaulter alert mechanism. Again, there are watch out lists in public domain. There are softwares that are available where customer names or their KYC can be flagged as part of there being certain issues or regulatory non-compliances at their end, which can these entities can become defaulters as the case may be, or all already defaulters. So whether the company or the sales department has the insight to know which of these are defaulters, which of these are problematic parties before you enter into any sales transaction, again, which will help you curb litigation or bad debt issues. If you don't see this, these are insights that internal auditors can bring in by using automation, by using softwares which are already available. Do not need to do much. It's just providing that insight and ensuring every process that comes under internal auditors purview is efficiently done, and insight is provided adequately. Process for setting the credit limits in terms of value, which is INR, and credit period, that is in terms of days, for new customers, existing customers. Whether firstly that process exists. If it doesn't, that starts with phase one to create the process and then begins following the process. Creation of fictitious duplicate customers in ERP. Again, if you remember previously, we have seen the conversion, the comparison of vendor masters with the employee masters. Similarly, here as well, if a staff member is also disguising as a fictitious customer, certain data fields in the customer masters can be compared with those in the employee masters, and such things can be pointed out. Security collateral that are taken for large orders, bank guarantees. Very important is our role does not end by just seeing whether there is a bank guarantee. When there is a bank guarantee, firstly, is the value adequate? Is the bank guarantee active at the point of audit or has expired? Is the business currently being done at a value that is far more than the bank guarantee that has been given? So these are certain parameters that we as auditors can review and bring out. So our job does not just end with bank guarantee taken tick. Not the case. We have to point out, because that again can create a risk going ahead for the client company. Existence of customer credit masters. In a ERP environment, most ERPs do give the functionality to create masters. The masters are the source, be it vendor masters, be it customer masters, be it employee masters. It is the source of information if the ERP has to function well. So, firstly, checking for existence. Second, to check whether conflict of interest is not there. The person who's making an entry into the masters is not the person who's also amending without any authority. So, very important from internal audit perspective is to review all these masters. From an IT control perspective, whether delivery orders are generated for defaulting customers, um, that is an example that I gave on the previous slide as well. If there are defaulting customers, if there are blacklisted customers, A, are we firstly entertaining them? Secondly, are we sending and delivering goods? Because again, ERP environment, it can be flagged. If it is blacklisted, tagged, then when the customer account is temporarily blocked. So for unblocking, again, the log has to be created from an authority matrix perspective. So our study of the ERP should be so robust and so much in depth that we see and we study the logs as well to ensure that there is no wrongdoing in terms of just to add business. Silo number three is delivery, which is order fulfillment. So a control risk example here is open sales orders for prolonged period. Now the example I want to give here is uh, so there were 100 sales orders totally issued, which had quantity of 100 kilos, but partial values of these sales orders were left untapped. So for example, if 100 kilos was one sales order, you know, just 80 was the actual delivery against the invoice was made for 80, so 20 remains open as a sales order partially for prolonged periods. Now if it remains in the system and this builds now, especially in large companies where these partial open sales orders, if they are not deleted or they are not closed with predefined tolerable period, then this may remain open for prolonged periods and just show a wrong picture as to these are the sales orders that are not delivered or yet to be converted into invoicing. So a 15-day or a 1 month post the terms that are agreed upon with the customer, it can be closed or pre-closed as the case may be if that balance 20 is not going to be catered against the same sales order. So that activity firstly should be done as part of the audited departments and the process owners. But us as internal auditors, it should be our checkpoint to make the process more robust. Verifying if the orders were delayed due to a lack of coordination between marketing and production departments. Again, a fallout or a result of this particular gap is having a reputational risk because the orders are going to be delayed. Orders delayed will also result in delayed billing resulting in delayed recoveries. So that is again going to be a stress on the finances as well. So the source itself is to check whether there is any gap in terms of coordination or communication between cross-functional departments. Coming to the customer complaint mechanism or the CRM, we've seen this mostly in service providing entities where you are dealing with the customers from time to time, and it's more from a customer relationship framework. The reputational risk here is also if complaints remain open for prolonged periods. Now, this particular item, which is customer complaint mechanism, there is an escalation matrix or a response by when you have to record, by when you have to respond. It's already documented. Keeping a complaint open for prolonged periods will result into an escalation. So hence, whenever you look at a customer complaint register, firstly, look at it from a recording perspective, whether complaints are being recorded. Is the TAT as per policy being adhered to, or is there an overrun there? Are escalations being made if the first level authority is not replying in time? How it has been settled, how it has been closed, has it resulted in any loss of customer or loss of business? And finally, with regard to approvals, is there a maker checker in place for customer complaints? A, by the person recording and the person finally taking care of the complaint. Sales returns, what are the reasons? What is the root cause analysis? Again, from a perspective, because in this particular silo of delivery, a sales return after delivery will entail the transport cost to be borne if it is a term where we have to ensure delivery to the client's place. So again, the same case of concrete. If you take a life of concrete, typically is around 180 to 210 minutes. When the transit mixer actually reaches the builder's location and it's a sales return, by the time it reaches the factory premises back, it is of no use and it is going to result in a loss of business anyway. So it's very important that sales returns are tagged with the right reasons and root cause to ensure that those gaps don't result in a loss of business, second, loss of revenue, and thirdly, impact on the cost of production. The three-way match that we saw in the P2P, here the three-way match can be also done in terms of Weybridge data, outward register and sales register. Each data field can be compared in these three registers that come out as part of the ERP to ensure that there are no gaps. Process of quality control checks. Post delivery, the quality control has to be checked by us. So how it is documented before the orders go out, whether samples are verified, whether they are documented, and whether there is a QC check stamp. This again takes care of reducing any cases of sales returns or complaints that are coming after delivery. Last mile delivery tracking, GPS. Okay, again, very most of us use Swiggy, most of us use Zomato as well. We know when the orders are leaving the restaurant, when they're coming to us, so we are tracking the basic delivery. Similarly, taking the same case of the concrete mix, the transit mixer, GPS tracking is possible in terms of tracking from factory to the client place to ensure that there are no deviations in terms of the truck using the recommended route and reaching in the recommended time, not having a lot of stationary movements, just waiting at some points so as to delay the deliveries. So delivery tracking is something that also can be evaluated to make the process more robust. E-waybill mechanism, if it is automated in terms of being generated in the ERP and automatically on the portal, that's great. If that is not the functionality available for us as internal auditors, we'll have to check the e-waybill register that is maintained in the records of the company during audit versus what is showing on the portal, and just validating or authenticating that number to ensure that it is a valid transaction. Coming to the second last stage in O2C, which is your billing and the receivables, teaming and leading. Many of us already know what teaming and leading means. So, are we seeing any cases where such adjustments are made? Is an auditor's perspective, but a very important checkpoint for us in this particular process when we check billing or receivables. Unauthorized amendment of credit limits. If the credit limits are entered into the ERP, again, as per authority matrix, only those changes should be made. So for us as internal auditors, important for us to check the logs as to who has added, who has amended, who has deleted, so that we can check whether authority matrix has been followed or not. And if not, whether then unauthorized who has done it and reach to the root cause. Similarly, unauthorized write-off at bad debts. Typically, bad debts would be written off by the management. From the finance, it goes to the management, and the sign-off is there. And only after that, the impact is given in the financials. Any other authority, approving this particular write-off can be an observation, and we should bring it up as part of our draft observations discussion. System followed for the balance confirmation by customers. There are softwares that are available where balance confirmation can be automated, where you fill the amount that shows on the financials, example 31st December, and with the email ID, it can be an automated communication to the customer or the vendor where balance is confirmed. If it is not, reminders are sent automated. That creates a trail for the audit as well, and helps the company keep that communication in a much more structured manner rather than sending random emails at various points in time during the year. Receivables exceeding credit limits but no alert. If the ERP has the functionality to flag whether the credit limit, for example, 1 lakh is the credit limit for a customer, but current outstanding debtors stand at 1.5 lakhs. So is an alert given to by the ERP to the finance team or the sales team, so that they can take certain actions to ensure that recoveries are kept within and the balance outstanding is kept within the credit limit. So that functionality can be checked, and that insight can be given by us as internal auditors. Ongoing litigations, reason for delay. Now, an example that I had seen previously is where there was a certain case of litigation with a customer at a client where there was no response being received. The letters also were coming as a bounce back. So in this particular case, when we looked at as part of internal audit, we saw the address on the envelope that was being rejected multiple times. We vetted that address on the ROC platform. In this case, it was a company, and ROC showed us a different address. And then we came to know the address had changed recently. We provided that screenshot to the legal department saying, this is the address that is showing. Please try sending it here. And immediately, the next envelope that went was accepted, and then the litigation process could proceed. But there was a certain prolonged delay, And that was again sort of an improvement perspective that we could bring as internal auditors, which was appreciated by the legal and the sales team as well, because they were hitting an obstacle in terms of that particular customer. So these are small things that matter, but that insight or that 3i view that we can bring as internal auditors is absolutely important. Price difference between invoice and customer POs, that if you see gaps in terms of the data fields, is something that we should again bring out. It's again very similar to what we saw in P2P. Cutoff procedures, very important aspects, typically done at the year end. So in this case, there are four registers where I will suggest cutoff procedures to be done. On 31st March, the purchase register, the gate inward register, the sales register, the gate outward register. Take the cutoff on 31st March itself, download the registers, keep it as part of documentation. So when you're doing the audit beyond 1st April of that year, you will have the cutoff registers with you, which was showing on 31st March. This will avoid any cases in future. If you were to download and you see any additions are being made on 31st March or any other day, you have that wherewithal to point out certain entries that have been made later or certain entries that have been deleted. So on 31st March, doing this cutoff procedure is absolutely important. It should also help when you're doing a physical verification of stock. This cutoff procedure again helps because from 1st April again business has to start. Counts typically are done on 31st March. Again in future, if you want to see that same data piece on 31st March afresh in the ERP, any gaps or any new information that you see can indicate that certain items have been altered. Higher sales towards the month end and subsequent reversals. Now, this example comes out from my experience in dealership industry, automobile dealerships. Any industry where salesperson commissions are, linked to the sales that are done in the particular month and paid out. This is an important checkpoint for us as internal auditors. Study the sales that were done, and if in the next month, in the first week, second week, are you seeing any subsequent reversals of the sales that were done in the first month? Because the commissions will be booked on the previous month's sales, but are they taking the impact of the reversal of the sales return while adjusting the commission for the next month onwards? So this is important for us, else the impact will be that excess commissions will have shown to be paid, whereas the sales have curtailed because of sales rejection or sales returns in subsequent months. So this should be a checkpoint when we do process audit. Match the customers to the suppliers list, whether vendors and customers are also having any common names and common data fields in the masters. Does this indicate any round tripping with regard to inflate sales or inflate purchases or inflate profits? This can be an indicator. So if this is not a checkpoint for you as of now, you may want to add this as a checkpoint as well. And last stage of O2C is typically receiving of payments and reporting. Certain checklist suggestions from my side would be procure the cancelled check copy of the customer's account as the KYC. This will help in the scenario where bank A was taken at the time of onboarding. Few months later, invoice shows some other bank number already, and whether then that proof is also taken or that goes unnoticed and still payments are being made to the bank B account. So procuring a cancelled check copy as part of documentation will help, because then we have documentary proof that this account actually belongs to that particular customer. Expiry of bank guarantees, status of credit offered. The tracker of bank guarantees will help flag whether, firstly, it's active, it is expired, and whether the value of bank guarantee is less or more than the business that is done. So this will help us as internal auditors to review from a quantitative perspective as well. Check the bank account and address of the customer versus staff bank records. Again, this is a similar point to checking employee masters and customer masters. Backdated instruments, if you were to look at customer contracts, if the customer contracts typically begins today, that is 8 January 2025, and the stamp paper, if you see, is dated 31st Jan 2025, that would indicate that the stamp paper and the agreements were done beyond or with a delay. So are you seeing any backdated instruments as part? Our job does not end by just seeing an agreement in place. We also have to check it from various perspectives and checking with a much more detailed third eye. Verify the following follow-up mechanism of the sales division. Again, this will when we study the receivables or delayed receivables, especially those which are beyond 180 days, 360 days, and up to 3 years. We, as internal auditors, can give certain suggestions for improvement in terms of how they can improve the follow-up mechanism to bring it into a more, achievable, or a situation where it's just 0 to 30 or 30 to 60, which is more better for the financial performance of the company as well. Recurring cases of check bouncing, any legal action. The Negotiable Instruments Act also speaks of check bouncing being an offense. So, are there any recurring cases of same customer where checks have bounced? Then we may want to suggest moving to RTGS or a NEFT mode to avoid, or an advanced mode to avoid any check bouncing aspects, because legal action will be a result of the same and will again incur costs. Non-payment by the customers, can we recover from the agent commission? So this is important, where distributors are front-ending for customers, and our payments to distributors are, or agents are, based on the sales that they bring to us. But if the customer does not pay us in that particular case, the suggestion could be to recover from agent commission so that the company does not lose any money here. And today, all of us are in the UPI era. So not having cash or not having check as a preferred mode, can we move to the wire, the UPI, or NEFT, RTGS? This will make it far more robust and keep financial matters more cleaner. So again, if digital payments route can be followed, it's far more preferable. Some observations that we've seen in sales audits, which I would like to bring out today. And first one being sales delivery prior to sales order. Again, the cycle of O2C and P2P has to be followed. So in P2P, the delivery cannot happen prior to the sales order. So that process was seen as a gap in a particular case, became an observation. Customer PO against which no sales order was created. The logical implication here is we lost business as a company because the PO was received from customer for an order, but sales order was not created, hence not taken ahead and converted to business. Pending sales order and its aging. Again, sales orders not converting to invoicing is lost business anyway, because it does not invoice and then money is not received. So business is lost again. Dispatches made but not invoiced. This will have a direct impact on financial risk, where dispatches are made but you have not received, or not because you've not invoiced, you've not received. So it will not it will have an impact on negatively on the P&L. Completeness of KYC in the customer masters. Whenever we review customer masters or vendor masters, the KYC data fields are absolutely important. In our observation that we saw, GSTIN was not tracked as part of the masters, although it was seen on the invoices. So making the masters more robust is also absolutely important. So while we are on this point, I would also like to note that when we onboard certain vendors or onboard certain customers, the KYC, for example, again GSTIN, was there at that point in time. As we progress, there may be cases where GSTIN is cancelled, it is amended, or it is revoked, as the case may be. So, is there a mechanism within the company's resources to vet these GST numbers, whether they are still active or not? An implication of that is, if we are claiming ITC, not looking at the GSTR 2A 2B, and those numbers are inactive, those GST numbers are inactive, we will not get the credit. So at that point in time, the source comes again back to the masters. So reviewing masters on a periodic basis is absolutely important. Transaction with block customers, defaulting clients, again resulting to bad debts. Hence, seeing any instances here should be flagged. Recurring changes in customer masters data addresses, for example, other any data fields. If it's more recurring in a year, you are seeing the same customer changing their address or GST number or name, more recurring, it can indicate certain other aspects as well, which can become more serious later. So if you see a certain trend, the trends can be brought out as part of discussion, at least to ensure whether everything at the customer's end is right. Segregation of duties within sales team, again conflict of interest being a problem. Ideally, all responsibilities should be spread out across the sales teams to ensure that there is no conflict in place. Weybridge data mismatch with the sales register data. This was an implication that came out of the three-way match, and it had an implication on the inventory as well as financials. Credit limit days violation. Credit limit, the days were incorporated as part of masters, as part of the PO, but actual on ground, the recoveries were far more delayed. So then it pointed out that the root cause was delay or lag in the follow-ups, which is why credit limits were not being followed up and the ERP also was not alerting. E-way bill mapped with sales. In this particular case, e-way bills, although they were issued, they were not being recorded as part of the sales register. So that functionality was brought out when we suggested this particular gap to the client. The IT was framework was made more robust. And lastly, if you look at one qualitative aspect where capex, sometimes new plants, new locations, new machinery is suggested, and the plans are very grand, and investment is made, saying that sales will increase from 1 to 10. We also can look at it, 1 year down the line after the capex is done, whether the plans actually were fructified and we could see the benefits which the company was expecting. In this particular case, investment was made, but the promised impact on sales was not brought out, which again was a gap. So this we could bring out as part of discussion and discuss more business oriented aspects rather than keeping it more compliance or transaction oriented. This is a suggested way of how reports can be drafted with your header. Next is your observation grading, which is high, medium, or low. Root cause, as I mentioned previously, people, business process, or IT. Towards the right, it's the population that you cover, especially for the data that you extract from the ERP. 100% is the data dump that you can download from the ERP and analyze, of which how much error quantity in terms of value you're finding out, you can note down. Coming to observation, giving a background of the observation, if it is backed with a statute or a regulation, you can mention the same as well. And lastly, the observation as to what has gone wrong, giving a background of that and mentioning the gaps that we have observed, and accordingly build the observation. Coming to implication, categorizing various risks, be it compliance, operational, reputational, financial, fraud risk. There are many risks, again, depending on the type of observation that we are bringing out. Recommended action in terms of after the exit meeting or during the exit meeting, discussing and ensuring that the recommended actions will be followed. And if there is, certain suggestions or inputs that we take from the auditees, tailor making or customizing the recommended actions so as to ensure our intent as internal auditors is met. At the same time, it is more practical for the auditee to follow. Recommended action will take care of those suggestions there. Responsibility of the department, target date that's agreed upon by the audited department to correct this particular anomaly is recorded here. And management comments is the last, where management comments from the auditee side as to their explanation as to what went wrong, whether they're accepting and what is the action they are going to take is elaborated. Coming towards the end of the presentation, I have two slides which, again, as part of experience, I would like to explain certain challenges that we may face as part of internal audits, especially in SMEs. And the lastly is where is the scope for value addition that I will come to on the next slide. If there are legacy practices at the client organization versus documented SOPs, board's intent many a times will be that documented SOPs have to be followed. It is absolutely important, but many a times legacy practices, because the person is in the system for a long time, there are certain deviated practices that you may see on ground. Our job is to be objective, unbiased, so bring out the gap analysis report. Although this may look like a challenge, it is in our hands how we make it as an opportunity and ensure improvement is brought. Resistance to change, be it in people, business process, or IT, the suggestions, if we do not, or recommendations, if we do not explain as to why we are recommending it, what is the benefit to the company to make their life easier, there will always be resistance to change. So, how we communicate our recommendations or suggestions in a much more better manner, in a clear manner, is in our hands. So, again, that's a challenge to start off, but it's in our hands how we convert it. Internal audit typically would be a compliance requirement or a cost center. But if we bring out value additions or we point out certain parameters and we speak business in terms of during our audits with the client, it will then slowly start to move from a profit perspective also, because if you point out cost overruns or revenue leakages, it has direct impact on the performance for any of the HODs. So then it does not no longer remains a cost center or a requirement per se. Lack of top-down approach. here the challenge is when the management itself is not intending from the true intent of why internal audit is important, and just doing it as an activity. That can be a challenge, which we may have to tackle. Pressure on audit fees, disparity in work versus fees. So basically, the resources that we deploy, the time that is spent, again is cost for the internal auditors. But if the fees are not commensurate, then it will be a burden or can be a challenge. So again, we must be knowing that we are going to face this challenge and accordingly tackle it. Focus on the financial audit instead of process or risk based audit. Today's topic being process based audits. Financial audit is the way it was done traditionally, where vouching, ticking, and only doing a P&L ledger scrutiny would be important. But slowly, as we are moving towards risk, process based, continuous monitoring audits, agile auditing, many concepts are coming in. We also have to move. So although that was the way, today it's not, no longer the way. Investment constraints, upgradation of systems, ERPs, tools. So whenever we give recommendations, or why those repeat observations are coming, can also boil down to the client not being able to bring those functionalities during these, or due to these investment constraints at their end. Lack of cash flow, can't invest more on technology, so we can't use automation to take care, so that manual activity will remain, which will create a door for repeat observations. So that again becomes a challenge. We must participate in being with the company to ensure that we go to the journey together to ensure that they become more efficient. But these constraints do come. Precaution versus cure. Many a times in our study as internal auditors, you may see news reports where, for example, ROC has given a notice for certain non compliance to a company, giving that insight to client organizations that, yeah, this is a notice, you must take care of this, is a precaution. A cure is typically going to result in a penalty or an interest anyway. So that value addition comes as part of precaution. So taking this example, it may apply across various other processes, but try to preempt a particular thing going wrong, and informing the client, before it becomes or converts into reality.
Hi, Samit.
Yeah,
Yeah, we have 20 minutes
sure,
because there are question answers also.
sure. I'm almost done.
So, yeah, okay. Yeah,
Yeah. Yeah, coming to the last one, which is weak internal controls, maker checker. Again, that becomes a challenge, but with automation, I think we can convert this challenge and make it more efficient. Now, this slide I will just keep open and quickly go through it. This is the last slide. It's about how value addition can be brought. Certain important aspects, and what I want to drive is continuous updation of your skills. You undergo training, you undergo certifications. Today, you're at an internal audit webinar. Similarly, ICAI has various other webinars for other certifications as well. So that continuous updation is very important as a professional. Only then will you know where the market is going and give value add. That's one. Um, Second, out of this list, I would like to point out is benchmarking with where the industry is going. That insight has to be given, or is preferred, that if you give that insight, it's more appreciated and value add. Try to shuffle the quarterly process audit runs every year. So if P2P was done in Q1, next year when you do P2P, try to take up Q3, so that you see various cycles, various seasons of the year as well, and not keep it static. Work not documented is work not done. As auditors, be it statutory audit or internal audit, documentation of observations, evidencing, and the entire communication trail has to be documented, start to end. Only then will we be able to substantiate if at all a query comes in future. The thought I want to leave you with is try to move from an internal auditor mindset to being a trusted business advisor to the board, to the management, because that is where the real value addition lies. And that conversion or that journey is far more enriching for us as internal auditors today. Failing to plan is planning to fail. First pillar of internal audit, if you plan to fail, if you fail to plan at that start itself, it will not be a successful project. So, with this quote of Benjamin Franklin, I finish my presentation. Thank you so much, and I hope you found it to be of value.
very much, Samit. I agree to the last quote that you showed on the presentation. Very detailed presentation we have today. So let us just quickly see what questions we have.
Sure.
Okay. So first question is from Sundara Raghavan. What is the difference between process and operation audits?
So process and operation audits typically are similar. When you say or process audits, it will be your core processes, like I mentioned, production, O2C, P2P. Uh, in support, you'll see IT, HR, accounts. So these are processes. Processes are operations. So these are various nomenclatures. Like for SOP, you say flowchart, you'll say process manual. It's an SOP at the end of the day. So similarly, process-based audits are going to be operational audits. The reason we call it operational audits is because internal audits are no longer financial audits. They are based on operations. Now those operations are sub-operations, which are purchase, sales, HR, inventory, logistics, distribution, various. So to answer that question, it is the same logic, but having an end-to-end process review, be it a process review, be it an operations review, is the same goal that we are going to achieve.
Okay. Next is from Jinam Shah. What are the major risks in P2P and O2C audits?
Okay. So that is a question for which a session has to be taken again. But if I were to categorize the risks, the broad risks will always be financial risk. Now in P2C or P2P or O2C, let's take an example in P2P. If you are going to make a payment which is beyond what you've agreed, it is going to result in excess payouts. Again, your stress on working capital management, again, is going to impact your financials because cash flow is going to be impacted. So, and again, profit also gets impacted because you're booking a larger invoice. So, first risk that we see is financial risk, which has a direct impact on treasury, working capital management, or financials. Second is operational risk. Operational risk is typically a deviation from the agreed practices that we have. So, that an example of P2P would be having a PO before a PR, having an invoice without a PR. There are various permutations and combinations to it. Five risks that I look at as part of internal audit, where you're making a report and these risks are going to come, is your financial risk, your operational risk, your compliance risk, your fraud risk, and reputational risk. Beyond this, it again becomes safety risks, and all those risks are also there. But given P2P and O2C, which are today's topics, typical observations would be categorized in these five risks.
Okay, thank you. Next is again from Jinam Shah. What if received responses are negative and not in line with the observations?
So this response that we have received is received from the auditee, is what I'm assuming. So if they are giving us wrong responses or incorrect responses, and we know as auditors that this is not intended, the practice that we follow is we give a rejoinder at the end of management comments, where we give our views as internal auditors as to we do not agree with the responses given, and we give our views in a couple of lines to close that particular observation. Else, what will happen is we are bringing out an observation, we are giving you the recommendations. The management comments speak a different story altogether, and then it leaves that observation half ended. So, that rejoinder is very important at the end, that we conclude as internal auditors that we are not satisfied with the response given to us, and for ABC reasons. Hence, we advise to revisit and resubmit the particular management comment. That is how you close it, but it's important for us to document it before we issue the final report, because after that, it is deemed that you are accepting it. So that
Okay.
opportunity you should not leave.
Yeah, so it's very important to conclude our points as well, in
Absolutely.
case we are not in line with the observations.
Our opinion is very important on each observation. So
Yeah.
close it.
Okay. So there is also a request to share the presentation from the same participant.
I will send the board,
Yeah.
to Arunji, I will send the presentation, I think.
Okay. Okay. Next question is from Subramani Iyer. Can you please explain the significance of valid PO acceptance, amendment to PO, or GRN? Internal control, IS aspects related to these to avoid disputes, fraud, etc. Big question.
Okay. So, I'll try to give a simplified answer because it's a large question. Whenever a PO is issued, firstly, the suggestion or how we should look at it as internal auditors is the PO should uh, come out of the ERP or the system or the software itself. It should not be a Word document. If it is a Word document, it will be amended, and that is what causes the problems later. So the PO register number, again, if it is serially numbered, given by the system, and automated, if we can have that functionality where that PO is also given directly to the vendor, most ideal. If not, it's generated from the ERP. We download that computer signed PO, email it from the authorized person, who's the purchase head, for example, to the vendor. Then it becomes an adequate communication from the company side to the vendor, which is a confirmation of the order. The POs typically are done where rate contracts or contractual agreements are not there. So having that automated process is most ideal. If not, periodically on a weekly basis, if POs are issued, but ensuring that all the POs listed in the register are issued to the correct email ID that is mentioned in the masters. So that is why the importance of masters also comes in. If we take care of this communication in line with the master information that we have, the chances of litigation, errors, issues further comes down, and the transaction can be very smooth.
Okay, thank you. This is from Mr. G. Sampath. I feel internal auditor should also check the control on alteration of PO in terms of authority as who is authorized to alter. I think this is
Absolutely.
his observation, right?
Absolutely. No, no. Valid
Okay.
observation, and it's
Yeah,
something that I've covered as well. So I
yeah.
think I've spoken on it, but valid observations.
Okay. This is from Mr. Iyer again. What are the major SOP problems, pitfalls in foreign purchase contracts, order to pay, and necessary precautions to be taken? I think he refers to imports.
Understood. So I'll give you an example that I had seen last year in one of the clients. What happened was, this is a manufacturing entity where they were manufacturing specialized equipment that is used in healthcare. There is business in India, there is business abroad as well. Now, as part of our O2C audit, we were checking the distributor agreements, the customer agreements, and whether the terms are recorded as part of such agreements or not. What we could see is domestically 80% of agreements were maintained. But when it came to the foreign agreements, we could see only one out of 234 transactions or 234 clients, they had documented the agreements. Now, for us, it was very alarming. We brought this out to the MD, and the board was completely unaware, the MD was completely unaware. So, being our first year of audit, we could bring out that observation and tell the board something that they did not already know. So, when dealing with foreign entities, this is one aspect where documentation has to be absolutely clear, especially when you're sending items out of India. Very important also is, in FEMA, as far as I'm aware, if there is delay in remittances of foreign exchange to as a recovery from the customers, there is also a non-compliance on those perspectives. Right now I don't remember the section, but two broad takeaways here is have your documentation in place, and the monies that are coming from the foreign customers inward to India, again, documentation is one, but at the same time ensure that there are no delays beyond what FEMA allows. Absolute adherence to all the acts that apply, we must ensure. Now, having said this, many a times internal auditors may not be the experts in FEMA, may not be the best tax experts also. But if we can give certain insights and recommend taking opinions, from the tax consultants that are already working with the company, this will help the company in a much bigger way because the specialized expert is going to opine, but that query has to come from the company to the consultant. We many a times, if it's beyond our scope, you can see, but you can't advise because half knowledge is not right. At least ensure that that query is being solved, and you are sort of insulating the company from any future regulatory issues. So either you solve it yourself with full information, or point it towards the consultant that is already onboarded for this particular reason.
Yeah. Next is Prarthana Raj. More highlights on cost-effective automation on API and AR confirmation.
On the AR confirmation. So, like I mentioned, there is a software which I would not name, but the software basically takes care of your bank reconciliation, uh, your bank balance confirmations, your vendor confirmations, your customer confirmations. Typically, as part of audit, what we have seen, if you don't use softwares like these, what happens is you ask the auditee, "Ki give me your top five debtor confirmations, give me your top five creditor confirmations at the end of the quarter." The response you will receive is typically, "I have sent the email and the customer or vendor is yet to respond. So we are putting a line that if you don't respond in 7 days or 10 days, we are going to deem this as final." Now, this is one way to look at it. The second way to look at it is using softwares where the value that shows in your books, be it AP or be it AR, you mention you mention the email ID, and automated that software will send that particular communication that this is the balance shown against your name on 31st December, da da da, and it goes to that intended email ID. Please confirm. Now, only that vendor or supplier or customer has to confirm. If they don't confirm in particular time that is already defined in the software, a reminder will be sent. Second reminder will be sent. Third reminder will be sent. And still, if the response is not happening, then we can deem as confirmation because this log is now created. How we also look at it is just the log is not important, but it's also important that why is that person not responding. So two ways to do it. You can either call or ask the customer, the company to call the customer to see, Baba, why you're not responding, or is the email ID right or wrong? Has that person left the organization? Is that the case? So then you enter into the root cause. But any process in today's time, if you're doing an internal audit, if you see automation that is available in the market or other peer companies are using, try to suggest. If there is no investment constraint, the company may go for that software and make the process more efficient. Makes our life also more efficient and easy because as internal auditors, we are now using automation. That is how I would look at it.
Yeah. Could you, this is from Mr. Rajesh, could you provide a glimpse of RTR process audit flow?
Okay. RTR typically is the finance one, I think you're talking, but it's not today's topic.
Yeah.
Uh, I mean, finance is typically you would like to see all the items that flow into the financials. So, as long as that aspect is being taken care of, we are okay. In that, what will come is typically your transaction level auditing. You will want to see the taxes. Every item in the P&L or the balance sheet that flows compliance to accounting standards, be it Ind AS or be it the Indian GAAP, and compliance with all the accounting guidance notes and everything that finally have an impact on the financial reporting. So the intent of the audit would be to ensure that we have a reporting that is most ideal without any gaps. So before it goes to stat audit or stat auditor for their audit, we are at a first level doing the check, bringing out the observations, ensuring that they are taken care, so that lesser observations would come as part of statutory audit. So again, that is a mode of value add also to the company because it makes their life easier because we are supporting them on correcting certain issues before it goes there.
Uh, this is from Nikhil. Any particular approach to be followed to present or discussion ATR before independent directors?
Okay. Any process to be? Can you please repeat once more? Just if I missed
Any
something.
particular approach to be followed or to present or discussion ATR
So
before independent directors?
okay, so broadly, let me first tell you how we should be dealing with the independent directors. Some companies I deal with, the independent directors prefer to have a discussion prior to the audit committee because audit committee typically will not allow us that kind of time to ensure or to discuss freely. So there are some boards where independent directors have a one-on-one with internal auditors to ensure, and they want to know the actual ground realities with regard to what's happening. So that applies to ATR, that applies to any other pressure tactics. It also applies to any other issues that we have seen on ground but not able to report for XYZ reasons. So when it comes to ATR, or compliances per se, the independent directors in today's scenario are very strict because there are far more penalties that have been started to be attached to independent directors in various boards. So they would want to know anything beyond operations, if it has to do with compliances or risks or penalties, that they will want to know as to why that has been missed, and a start to end story they will want to understand, either in the audit committee, or like I said, some boards will have a pre-audit committee which is only the independent directors and the internal auditors. That, if you ask me, is more suggestive and a good process to have, is because that shows you the top-down approach, and actual independent directors want to know and are much more interested in what is happening because they are not part of the day-to-day operations. Coming to that ATR question, ATR again will have all the observations which are open, be it operational issues or be it compliance issues. For operational issues, typically independent directors will ask to tackle it with the executive management, unless it is turning into something that is a bigger issue that can have a repercussion on them. But when it comes to compliance issues, every audit committee is very they stress on not having any escalations or delay in the ATR, especially for issues which are regulatory and compliance related. So that is where their focus is.
Okay. This is from Mr. Banerjee. In
Okay.
case of sales, for decrease in price, buyer does not lift the full quantity of material at a contracted price. Instead, they ask for supply of remaining material at the revised price, which is accepted by the seller. Will this revenue loss for supply of material at rates lower than contract rates be reported by internal auditor?
See, as internal auditors, we also know that we cannot step into business beyond a certain level. So our job is to firstly see whether what the process says, what that PO says, whether the terms are adhered to or not. Now, in this case, as I understand, the terms are deviated. We agreed at 100 rupees first, and then it came to 80 rupees, and business is still going on. Now, because it is a reduction in the price, it will have a implication on reduced revenue. What we as internal auditors would want to see is whether the levels of authority which were given in the authority matrix are knowing, have approved, and it is a business call. So if it is a business call, in our notes we will note it. We will also make it part of the draft observation sheet. But if it is not material, we may not make it non-reportable. But having said this, we will want to see the entire process start to end to ensure that it's a business call, and take that evidencing to ensure that it's a business call and the authority who is responsible has approved the same. If it is material, the judgment that I as an internal auditor would take, I would keep it in the report, because if it's a material amount, recurring cases should be avoided, and that is how I will position the observation, that once you have done it, it's fine. With the same customer, if you keep doing the same thing, it will become a practice. Then either you tweak the way you are doing the PO, so that you have the ideal rate in the PO, and this does not become a recurring practice. Once you allow it, every time it will happen. So that, as an internal auditor, why I would bring it is because I want the board to know that this is the practice that is being done by executives, and are you okay with that practice? Otherwise, I will check everything start to end to ensure that authority matrix, everything else is taken care of. But it's important to note and bring it to the notice of the board at least. Mostly this will help in the promoter driven companies, where families or promoters are very hands on in terms of this. Such calls, if taken by non promoter, then we must ensure that they are knowing that these calls are being taken before it becomes something big. So from an information perspective, let's do this.
Okay. All questions from attendees are done. One last from my end, Samit.
Yeah.
Uh, any particular AI tool or software that can be used for the topic we had today, process, streamline, planning, and all? Any particular recommendation to be used for AI tool or software?
So AI tools that I see in the market, one is Idea Caseware is a tool which is an international tool, and it is being widely used. Sun is a tool. MindBridge AI is a Canadian tool. So again, see, there are tools that are available in the market. Power BI, there are Tableau, Python. So
Hmm.
there are various aspects, but us as chartered accountants, we can't be masters of all,
Yeah.
and that's very important for us to know and have that reality check. So how I would suggest is, if the your setup allows you, try and explore the possibility to build a data desk or a data analytics desk, invest in technology, invest in creating this desk so that you have those persons who understand Python, who understand Power BI, who understand Tableau, rather than relying on these market tools that are available. You
Hmm.
can use certain computer languages through your own team and develop your own bench. So
Hmm.
if that possibility is there, you can remain the internal auditor and be the functional expert, give your views to the data desk, ensure they churn data as you expect, and take the exception reports and go on with your audits. That is an approach I would suggest. Again, it's a case to case. Don't rely on just the market tools that are available. Tools are there to be sold, but if you don't
Hmm.
use or you don't adopt to them, it's an
Hmm.
investment which is going to go waste. So try to create much more within the firm rather than relying on outside resources.
Okay. So we are done with question answers. So now this is my job to do. We really had a very enriching session today, Samit. Thank you for such a enriching session, which critically highlighted the role of structural process in enhancing the audit efficiency. Thank you for your esteemed sharing of your invaluable insights. On
Thank,
behalf of everyone present here, I would like to extend a heartfelt thank for your in-depth presentation, sharing your expertise, experience, and addressing all our queries so patiently.
sure.
Also, a big thank you to the Board of Internal Audit and Management Accounting (ICAI) for organizing this session and for their continued efforts. Thank you all participants and for your enthusiasm. We hope you found this session enriching and insightful. Have a wonderful day ahead.
Thank you, Atiji.
Thank you
Thank you,
all.
participants. Have a good evening.
Thank
Bye-bye.
you. Thank you.
Recording stopped.